Tax-effective giving is a phrase that's often used to describe how an individual can donate to a charity and minimise their tax burden as well. It should always be factored in that when you decide that you wish to donate to a charity, having those options available to you, both the convenience and the one that's going to minimise your tax exposure, are always things that one should take into account. Most individuals, in my experience, though, don't donate just purely to save tax, but having that as an extra bonus can't be a bad thing. The three schemes I'm going to outline today are payroll giving, gifting, or even selling land, property or shares to a charity, and lastly, the interaction between inheritance tax and donating assets, gifting assets to a charity. Last week's video, I looked at gift aid, so I suggest check out last week's video to get the full picture with gift aid factored in, a link in the video. Let's look at the first scheme that I mentioned, which is called payroll giving. Now, by its very description, it's a scheme that's applicable to those in work. And also, by the way, it can also be applied to your private pension as well. Now, the way the scheme works is as follows. Typically, an employer will engage with a payroll agency. There are 23, by the way, that have been accredited by HMRC. Again, check out the show notes and I'll give you a link to the HMRC link, which will show you what those 23 agencies are. You can check out the websites as an employer and see which one fits more closely with you. Now, what will happen is an employer will engage with a payroll giving agency. Each week or each month the payroll is run, the employer will take off what the individual employee has agreed to donate through their salary. That reduces the employee's taxable income, and the employee saves tax, and the recipient charity, which can be of the choosing of the individual employee. It can be a group collective decision by the employees together. You can nominate a specific charity. You can disperse that amongst a number of different charities. Now, that donation will have a reduction impact in terms of tax that's paid out. For £100, for example, that's given on a monthly basis, what will happen is if the individual isn't a basic rate taxpayer, their tax bill drops by £20. That deduction is taken off before the income tax is calculated. If you're a higher rate taxpayer, effectively you save 40% of that. So for £100 that's given through the payroll, £60 is the true cost to you as the individual employee. The charity gets the £100 less any fees that are charged by the payroll agency. And lastly, if you're an additional rate payer paying at 45%, then effectively it's cost you £55 and the charity gets £100 less any fees that are paid. And those fees can, if the employer so wishes to, be paid by them. Now, one of the powerful things about the payroll giving scheme is it doesn't have to be every single employee. Employees can decide which charity they want to choose. So it could be a local theatre, for example, company that's happened to be registered as a charity, or it could be a national one. It's the individual who makes that decision as to which charities they wish to support. And remember, folks, a charity is essentially a business that provides a whole range of services, crossing from the arts and cultural space to education, to health, community cohesion, and the like. The scheme is relatively easy to administer and to set up, and all the administration is typically taken care of between the payroll department and the external payroll giving agency. So that's mechanism number one, payroll giving. The charity, by the way, also gets a regular source of income, which is great for when it does things like planning, what its future will do. The charity finances can be quite volatile, so having a stable level of income coming in through payroll is a good thing for the charity. And also, the individual donates through their payroll, they get the tax saving immediately, and they don't have to worry too much about keeping records. That's all taken care of by the employer and the charity. Also, corporate social responsibility, if it's promoted actively, is discharged by the company and the employer as well. The second thing I want to look at is where, if there is such a thing, surplus land, property or shares, and you wish to donate that to a charity, you can give that to a charity and you will be income tax free, and also it will constitute a capital gains tax saving, i.e. there won't be any. Now, typically, most charities will require or request the individual to actually sell those assets and then gift those proceeds across. If you've got the relevant declarations from the charity and the notes, you can still claim the tax relief on that nevertheless. The value of that gift, by the way, that's been donated can be deducted of your income tax calculation, and therefore you've got a tax saving as well. Now, obviously from the charity's perspective, for the individual selling those assets and then gifting them across, what that does, that saves some administration, stock brokerage fees, etc. from the charity, and that's easier to handle for the donor than it would be for the charity themselves. The last area I want to have a look at is in what's called inheritance tax. Now, inheritance tax, which is largely, or within reason, an avoidable tax, is currently levied at 40% on estates valued over $325,000. Ignore the family home for now, and we'll deal with inheritance tax as a topic in its own right in a future video. But essentially, the main headline rate is 40%. Now, if you gift assets, typically through your will, to a charity, and the charity is registered, then there is no IHT, no inheritance tax, charged on the gift. Also, if you give at least 10% of the value of your estate to a charity, then your inheritance tax rate drops from 40% down to 36%. That can't be bad, can it? So let's just summarise, folks, again what those three main schemes were, in addition to the gift aid scheme that was discussed last week. You've got payroll giving, you've got the gift of land, property and shares, and you've also got inheritance tax, where you gift assets to a charity, you bequeath it to them. If you give at least 10% of the value of your estate, you'll pay IHT at 36%. Now, it's key to remember, by the way, folks, that charities is the structure. Those are all ones that are registered with the Charity Commission. But charities are fundamentally businesses that rely on funding from a variety of sources in order to carry out that much needed work. I hope you found this video useful. Let me know what you think. Are you a donor to a charity? Are you a business that's looking to set up? You need more information? Drop me a line, let me know what you think. And until next week, folks, happy charitable giving.